Hey there guys, Alex Hunkus. Today I'm going to be talking to you guys about the stock market in this fun little educational video I set up for you guys. So today, like I said, we'll be talking about securities markets, alright? So there are a few basic types of financial securities. Security markets are there to transfer funds from investors to firms that need financial resources to achieve their long-term goals. If these markets didn't work efficiently, it'd become really hard to obtain the financial resources that companies would need to expand, create jobs, introduce new products, and to be able to just compete in the global market in general. There are many ways companies can raise long-term financial capital through securities markets, but today we'll focus on three different ways that are most commonly used. The first way is a common stock, which represents basic ownership in a corporation. Owners of a common stock have voting rights. They can vote on major issues such as the selection of members to the company's board of directors. Common stock owners also have the right to dividends. A company does not have to pay a dividend, or sometimes cannot because of a bad year, or they can use the money to reinvest in the company. However, many companies have a very long and good, strong history of paying regular dividends to their stockholders. Common stockholders can also make a capital gain if the price they paid for it becomes higher than the price they bought it for. Preemptive rights allows stockholders the first opportunity to match their share of the company if more stocks are available for sale. For instance, if I own 5% of a company that's selling shares and they all of a sudden are out with new shares to sell, I have the first right to go and buy it to match my 5%, to buy more of those shares to match my 5%. So that's common stock. The second way of security marketing is preferred stock, which is similar to a common stock, but it offers more of a preferred, two distinct ways that are sort of preferred among stockholders. Preferred stockholders have a claim on assets that come before common stockholders. This gives them a better chance to recover their investments if the company goes bankrupt. Third securities market I'll talk to you about today is a bond. A bond is a long-term debt instrument issued by a corporation or government entity in exchange for funds. Alright, so now we'll talk about trading securities. There are two distinct components to the security markets. The first is the primary security market. The primary security market is where you raise additional financial capital by issuing and selling newly issued securities. There are two basic ways of issuing securities in the primary market. In the public offering statement, securities may be sold to anyone in the investing public that is willing and financially able to buy them. In a private placement, securities are sold directly to one or more investors, large investors, under terms negotiated between the using firm and private investors. The secondary securities markets involve trades of previously issued securities. Security exchanges are the biggest involvement in secondary markets. However, electronic communications networks has attracted a lot of attention in recent years. A security exchange is an organization that provides a venue for stockbrokers or securities dealers to trade listed stocks and other securities, such as the NASDAQ. Now I'll move on to a regulation of the securities markets. Securities markets only work if people have trust in them and the integrity and fairness of the system. No one wants to go out and buy a stock only to have it be fake or something and lose a bunch of money because someone else cheated or because the stock was fake. A mix of three major players regulate the markets. The first is state legislation, the second is federal legislation, and the third is self-regulatory organizations. First, I'll talk about state regulations. In the early 20th century, many dealers took advantage of the lack of this government control by trying to sell highly risky or fake stocks to very naive business owners or customers. After this caused a lot of financial ruin for a lot of people in the USA a public outcry for government step in was called out, so that the government would come step in and provide laws against unfairness and against being cheated out of money. The first state to pass any law was Kansas, who acted before the federal government ever did anything, and after that, most of the other states all passed very similar laws in a very short time. These laws became known as the Blue Sky Laws. The second way of regulation of security markets that I'll talk about is federal legislation. The federal government got involved in the stock market and regulation of it during the Great Depression years. There were two laws that they first signed that had to do with securities markets. The first two laws that the federal government created concerning the securities markets were the Securities Act of 1933 and the Securities Exchange Act of 1934. These two laws still provide the foundation for the federal approach to the regulation of securities markets. The key objective of the Securities Act of 1933 was to reestablish faith and trust in the securities markets after the great crash of October 1929. The Securities Exchange Act of 1934 dealt mainly with the secondary securities markets. I'm filming. The third way of regulating the securities market is the role of self-regulatory organizations. The SEC remains the ultimate regulatory authority of the securities markets. However, they pass most of their duties on to the self-regulatory organizations. These non-governmental organizations working in the securities industry develop and enforce rules concerning the behavior of their members. So that will conclude my presentation of the securities markets. I hope that you guys learned a good basis and simple foundation to the very beginnings and basics of the securities markets, and I hope that you guys can take this further and use it to have a good foundation for the rest of your stock buying career. And I'll set you off with that, and have a good day.